Okay, 11 o'clock. Let's get going. So I guess this week is Alex Wright from Fidelity Special Values. Just a couple of bits of news to look at first. NextEnergy Solar and then Schroder Income Growth. So NextEnergy Solar first. This chart is not great now. You can see the NAV is just sort of edging downwards, and so is the share price. Market cap is still a decent size. The discount at 28.8 is narrower than it has been, but the yield is still an almost 12.3%. And part of why I want to talk about it is clearly the high yield is not proving effective in encouraging investors to come in and narrow that discount down further. Here it says in the context of the sector as a whole, so nothing particularly remarkable on there apart from the size of that dividend. It's second highest in the sector behind STCL Energy Income, the yield rather than dividend. And here is the performance table. And here you can see that the NAV returns have been slightly disappointing, especially the 10-year ones where it's kind of bottom of the list. Disappointing relative to the sector, not absolutely, really. It could have done a little bit better, but it wasn't really intended to do much more than that sort of 7-8, I think. But obviously the share price returns have led down because of the discount widening, which hasn't helped. So it joins the long list of things that question mark over. This is the latest quarterly result. You can see here that the NAV fell again, down 2.3p. Most of that is down to reductions in power price forecasts, and we'll talk about those in a second. But obviously they are paying out a hefty dividend, and they're not generating enough to cover that at the moment in terms of NAV. But they are in terms of income. Now, the power price forecast fall, they say, reflects the external advisor looking at gas prices and saying there's so much new supply that gas prices are going to be lower, and so power prices are going to be lower over the next few years. And you can see quite a big drop from the grey line there to the blue one. And that's all fair enough. And we've also seen a sort of modest increase there in the longer term numbers. I spent quite a long time this morning checking against other renewable energy companies. These are not really out of line with what other people are saying. Now, one of the big things that's going to happen, we think, this summer is that the government is finally going to pronounce what it's going to do about regional pricing. And it may be that they say, yes, regional pricing, we want to do it, in which case areas with lots of supply and not a huge amount of demand will have lower prices than places with lots of demand and lots of supply. So it's fortunate then, I think, for NextEnergy Solar that most of its production is in sort of central England, southern England, and there's a little bit in the east where I think prices might be lower, but we don't know yet how it's going to be cut up or even if this is going to happen at all. So, but I think if it does happen, they won't be too badly affected. And in any case, whatever happens to power prices, it's massively cushioned because they've got quite a lot of predictable income coming from subsidies, and also where they've got power price sales, they're selling those ahead, so they know what the revenues are going to be for this year and more or less for next year too, well in advance. And obviously they carry on doing that as time goes on. There's no change to the discount rate used to calculate the NAV. So obviously they force the cash flows out, then they discount that back. But their assets have a life of about 25 years. And so we do need to keep an eye on what sort of long-term gilt yields are doing. And they are still creeping up. And this is, even though short-term rates are still coming down, as we said, they had the Bank of England rate cut the other day. That's unhelpful, but there's no compulsion at the moment to change the valuations. That's heavily informed by what you see in terms of sales of assets in the secondary market. Where NextEnergy has sold stuff, it's managed to get a premium to NAV for it. And there's been no other transactions that would say we need to have a sort of radical revaluation. Now, in terms of where we are with all of this, they are buying back stock. They are over halfway through now a £20 million buyback program. That's put about 2.6% of its shares in treasury. The gearing is creeping up, which is unhelpful because the NAV is coming down, and they think they do need to prioritise reducing that further. That doesn't include the preference shares, though, which means it looks worse than it is. That's sort of less of a worry. Are still in this process of doing the capital recycling program that they announced quite a while ago now. There's still 100 megawatts of solar still for sale. They keep reiterating that there's no rush for this, but I think investors are getting frustrated. We should be looking at about another 50 million quid's worth of money to come in. So we'd like to see that happen soon. The dividend cover for the year that's just ended, so the year to the end of March 2025, was 1.1 times, and they've decided to maintain the dividend for the coming year at 8.43p. So maintaining the dividend rather than increasing it is sort of big news in the sector because all the other things have been trying to march the dividends up. It looks as though, seeing they're saying the dividend cover target is sort of 1.1 to 1.3 times, that kind of implies that the operational cash flow they can see is going to rise, but they don't want to try to pay it out as dividend. I think this makes perfect sense, really. If you're not getting any credit for having a really high yield, then why bother marching the dividend up again? Instead, why don't you take some of that cash and use it to prioritise buybacks? And I think that is the sort of sensible thing to do. The chairman stepped down, and her only comment on the sort of big picture thing was to say that they regularly think about what to do about discount control. So that there's nothing radical there. But I think when we get to the results in June, they might have to say something a bit more concrete than that. That's NextEnergy. Schroder income growth. There's a chart there. The discount has been wide over the last sort of year and a half, and I think that really reflects its performance. And the 6-month numbers weren't great. It's held back by small and mid-cap exposure, which is a good excuse, really. Share price return was worse, the discount widened out again. They clearly needed to do something about that. This is from their fact sheet to the end of March, and you can see, so these are rolling 12-month periods to the end of March. It's a long time since they beat the index. We have to go back to the 12 months to the end of March 2021. And the long-term picture is not good. And that's a problem for it. And then if you look at it again in terms of the context of the sector as a whole, it's not very big. And its yield is not particularly high. That discount is relatively wide within that sector, which is part of the reason why they had to do something about that. And then the NAV returns are sort of not brilliant either. So I do think there were question marks about what should happen to this. So what they've done at the moment is they've decided to cut the fee. That's always a good thing. They're shifting it to the lower of market cap and NAV as kind of the base, and they reckon that will save about £300,000 a year. So tick, as far as that goes, I think. They're going to, they appointed a new co-manager, all well and good. They're also going to use buybacks to try and target a single-digit discount. I don't think that's aggressive enough. People have said to me, even with that, you could see it sort of disappear down the plug hole. I don't think that a fund that's fundamentally, I mean, most of it, I know it's got a buy small and mid cap, but most of it's big liquid stocks. I think it could have a lower discount than just slightly sub 10. And I think that means it's still vulnerable to attack by ARBs. So whether this one survives or not, I don't know. We've been saying that we need consolidation in the sector, in this part of the sector, for a while. We have seen some. I think it could be a target. So that's enough from me. I see there was one question about whether you think there'll be sector M&A in renewable energy, and I think yes, it's possible. I think we might see some consolidation within that sector, but that only really works if it also allows for some kind of cash exit at the same time. So how you structure that and who's the buyer is, that's the big question mark.